this session, we will discuss how to calculate the specific amount of your client's tax liability. If your client's taxable income is below $100,000, tax tables are used to determine the tax amount. Those tables are in the specific 1040 instructions. If the taxable income is above $100,000, then the tax computation worksheet is used to determine the amount of tax used. Using the tax tables is the easiest and most convenient way to calculate taxes owed. The tax tables show increments in taxable income, usually $50 increments, from zero taxable income to $100,000 in taxable income. Once the taxable income is determined, find that amount on the tax table in the column marked at least but less than. Then look horizontally across the page. Determine how your client is filing, single, married, filing jointly, etc. And look for the tax amount that corresponds with your client's requirements. That tax amount can then be transferred from the tax table to the appropriate tax return form you are using for your client. So, if your client has taxable income of $37,323, then you'll find the line which shows at least $37,300, but less than $37,350. If the client is filing single, then you'll locate the amount on that line in the column titled Single. It's that easy. As I mentioned, the maximum amount of taxable income covered in the tax tables is $100,000. If your client's taxable income is above that amount, the tax computation worksheet is used to determine the amount of tax owed. This worksheet is located in the instructions booklet right behind the tax tables. This worksheet provides formulas to use with all the taxable income levels above $100,000 and easily leads you through the calculation. Once the tax has been determined using this tax computation worksheet, you can transfer that tax amount to your client's tax return. There could be other taxes owed in addition to the amount from the tax tables or from what is determined in the tax computation worksheet. Major examples include reported child's interest or dividends, lump sum distributions, and tax related to health savings accounts. Let's discuss interest and dividends paid to children first. If your clients are parents, they may elect, if eligible, to report the child's income, like interest and dividends, on their own return. If the parents make this election, they file Form 8814, and the child won't have to file the 8615 and or his own tax return. The additional tax, sometimes referred to as kiddie tax, is calculated on Form 8814 and then added to the amount reported on the total tax owed. The appropriate box should be checked on that line of the form and the tax amount added to the total tax amount you have already calculated. The second example is for additional tax paid for lump sum distributions. What is a lump sum distribution? It is a distribution or payment in one tax year of a plan participant's entire balance from all of an employer's qualified plans, such as pensions, profit sharing, or stock bonus plans, in which the participant had funds. If there are lump sum distributions to your client during the taxable year, Form 4972 should be filed with the taxpayer's return. The tax calculated for that lump sum distribution is then added to the amount on the tax line and the appropriate box checked. The third example is for taxes relating to health savings accounts. If your client has contributed to a health savings account during the taxable year, Form 8889 should be completed to calculate proper deductions. It could be that your client owes additional tax as a result of contributing more to his health savings account than is permitted. This happens only rarely, but if it does, the amount of tax calculated should be added. Granted, these three examples do not occur often. More detailed information about these exceptions is explained in the instructions for each form. In the vast majority of cases, once the taxable income amount is calculated, the amount of tax is easily determined using the tax tables or the tax calculation worksheet.